Good morning. We will pay attention to the difference between assets, liability, equity, income, and expenses. Income will increase the profits of the business. Services rendered is an income when the business don't sell goods to make money, but they render a service, for example, a hairdresser, plumber, electrician. Sales is when the business sell goods, so they buy goods with the purpose of selling it at a higher price to make a profit. So sales is an income for the business. Interest income is income that the business earns on an investment that they've got at the bank. Rent income is received by the business if part of the building is sublet to someone else and they pay rent to the business to use this property. Expenses will decrease the profits of the business. Cost of sales is the expense to buy goods to be able to sell it. So cost of sales actually means the cost price of goods already sold. If we take the sales price and we subtract the cost of sales, we will determine the gross profit. So the difference between the cost price of the goods and the sales price of the goods is the gross profit. Stationery is used in the business, therefore it will not create an income in the future, it is an expense. Salaries, electricity, advertisement, etc. is all expenses, and all of them will reduce the profits of the business. Assets are the possessions of the business, and we divide assets between non-current assets and current assets. Non-current assets will remain the same for more than 12 months in the future. That is our fixed assets like land and buildings, equipment, vehicles, machinery, furniture, and fixed deposits in a bank where you will earn interest. Current assets will change in less than 12 months in the future. They normally change on a weekly or a daily basis. Inventory is goods that you bought with the purpose of selling to make a profit. Debtors are the people that we sell to on credit, so they owe money to the business and they will have to pay this money in the future. Bank is your normal checkbook account. Cash float is money that you put in the till to give change to your customers. Petty cash is a tin with money that you pay small amounts. And all these current assets will basically change on a daily basis. If we sell goods, inventory decrease, debtors increase, or bank increase. If they pay, then the bank increases, debtors decreases. So every time when a transaction happens in the business, it will either increase or decrease this current assets. Then we also have liabilities that's divided between non-current liabilities and current liabilities. Liabilities is obligations of the business to pay out amounts. Non-current liabilities will remain the same for more than 12 months in the future. That is, for instance, a loan to pay for a car that you will repay to the bank over a period of 54 months. A mortgage loan was obtained to buy a house, and you gave your house as security for this property, and it will be repaid over a period of 25 to 30 years. Current liabilities will change within the next 12 months. Normally, it will change on a weekly or daily basis. Creditors are the people that the business owes money to because you bought goods on credit. Every time you pay them, the creditors decrease. If you buy more goods, the creditors increase. Bank overdraft is when you owe money to the bank because you issued more checks than the money that you have in the bank. If you issue more checks, the bank overdraft will increase and your liabilities will increase. If you deposit money in the bank overdraft will decrease and your liability will decrease. Owner's equity means the money that the owner put into the business or what the business owes the owner. The owner's accounts consist of capital and drawings. When the owner puts money into the business, it is capital. When he takes money out of the business, it is drawings. When any of the information above was given, it is important to take into account the following steps before you answer the question to prevent mistakes. Make sure that you know the difference between income, expenses, assets, and liabilities, and that you know where they are used. So income and expenses will appear in the income statement to calculate the profit. Assets and liabilities will appear in the balance sheet to determine the financial position of the business. Income will increase profit. So every time when we have an income, the profit will increase. When we pay expenses, the profits will decrease. Assets are possessions that will ensure a future inflow of money. Liabilities are obligations that will result in a future outflow of money. So assets will result in a future inflow of money. Liabilities will result in a future outflow of money. Differentiate between non-current assets and current assets. The value of non-current assets will stay the same for a period longer than 12 months in the future. The value of current assets normally changes daily. Then you have to differentiate between non-current liabilities and current liabilities. The value of non-current liabilities will stay the same for the following 12 months. The value of current liabilities will change daily. Which accounts will have an effect on owner's equity? Only capital when the owner gives money to the business, so he is investing money in the business. Drawings is when the owner takes money or goods out of the business. So the two accounts that will affect owner's equity is capital and drawings. And when we calculate the profit or the loss, it will be taken to the capital account because the owner is entitled to the profit or he has to pay the loss. Before answering the question, you will have to differentiate between the information that will be reflected in the income statement and information that will be reflected in the balance sheet. Income and expenses are shown in the income statement, and the purpose is to calculate the profit for the year. If income is higher than expenses, a profit is made. If the expenses are more, then a loss is suffered. Assets, equity, and liabilities are recorded in the balance sheet to indicate the financial position of the business. Complete the question by taking into account what contribute to the profit for the year. Only income and expenses can be used. If assets or liabilities are used, marks will be deducted because you don't know what information should be used to calculate the profit. So the income for sales less cost of sales will give me the gross profit. Then we will add any other income that we had in the business and we will subtract all the expenses in the business. Income is shown as positive figures. Expenses will be shown as negative figures. So if you don't show them in brackets to indicate that it will be subtracted, you will not get a mark for the figure. Gross profit plus other income less expenses will give me the net profit for the year. What did we learn? Only income and expenses are used to calculate the profit for the year. The difference between the sales price and the cost price, that means the cost price of inventory already sold, will give us the gross profit. Then we have to differentiate between income and expenses, and if we add all the income and we subtract the expenses, we will calculate the net profit. Income is entered as positive amounts, while expenses are negative amounts that will be shown in brackets when we calculate the profit.